Are we just taking a breather, or is something much bigger shifting under the surface of the crypto market right now? Because honestly, you look at the headlines, the charts, and what everyone's buzzing about, it feels like all the signals are pointing in slightly different directions. Creates this incredible tension. Welcome to the Deep Dive, your shortcut to being genuinely well-informed. Today, we're plunging headfirst into the dynamic and maybe a little bit nerdy world of crypto, specifically what's happening on August 26, 2025. We've compiled a stack of insights, our go-to daily market overview, social sentiment from Crypto.Report, plus sharp takes from top YouTube analysts like Benjamin Cowan and the guys over at Bankless. Our mission, like always, is to extract the most important nuggets, connect the dots, and help you understand what's really driving things right now, and crucially, what you'd be watching for next. So, okay, let's unpack this current market volatility and that feeling, that palpable feeling of uncertainty that seemed to have everyone on edge.
What's fascinating here is precisely that complexity.
Yeah.
The signals we're getting right now are, they're far from straightforward. On one hand, you have compelling signs of a necessary cool down, maybe even a healthy correction after a significant run, sure. But then on the other hand, there are these underlying movements and critical macro indicators that could suggest something more fundamental shifting, a sort of breaking down of previous patterns. This tension creates a critical juncture. It makes this moment really important for anyone trying to understand crypto's true path forward. It's certainly not, a simple picture, not pure bullishness or outright collapse.
No, not simple at all. And for the everyday investor, it's easy to feel kind of whipsawed, right? Let's start with the current market pulse, what's happening daily, because it feels pretty shaky. After another wobbly Monday, we've rolled into Tuesday, and frankly, the market's still struggling to find its footing. Both Bitcoin and Ethereum look, quite vulnerable. Bitcoin especially seems stuck, weak momentum. For it to show any real strength, to ease some of this cooling off pressure, it absolutely needs to reclaim that $112,000 mark if it fails. We could very easily see a pull down towards, say, $100,000 if buyers don't step in to defend that level with conviction. The sentiment right now among a lot of traders seems to be there's just no reason to be turbo bullish for BTC right now. And that's a powerful signal, isn't it?
It truly is. That sentiment, no reason to be turbo bullish, isn't just a casual phrase. For an audience like ours, it actually signals a likely shift, maybe into a risk-off or consolidation phase where conviction's low and new speculative money isn't really flowing in aggressively. This matters because it suggests a shift from, say, retail FOMO to perhaps more institutional, cautious positioning. They're waiting for clearer signals before deploying serious capital. And that brings us to Ethereum. While Bitcoin struggles for direction, Ethereum seems to be in what you'd call a cooling off period after having run hot for a bit. It's actively correcting towards its long-term average price. Mean reversion, we call it. For ETH, the current target for this mean reversion looks to be near $3,600. And for traders, these specific price targets, $112K and $100 for BTC, $3,600 for ETH, they're significant. They represent key psychological and technical levels. Breaking these can trigger more buying or selling, impacting short-term strategies and the overall market direction. It's not just random noise. It often represents a rebalancing point where the market, including larger algorithms, starts seeing the asset as either over or undervalued. Creates a kind of gravitational pullback to that average. It's a classic sign of market equilibrium trying to reassert itself.
Okay, so the everyday investor might see BTC and ETH struggling and think, all right, this is just a necessary cooling off. Healthy? Maybe. But then you throw in activity like this whale drama, and it starts to feel less like a healthy correction, more like a potential crack in the market's confidence, pushing us closer to that breaking down idea. What's really happening there?
Precisely. And for our listeners, a whale in crypto means someone or some entity holding a massive amount of coin, enough to influence the market. And right now there's this giant kind of mysterious one on Hyperliquid that's mostly a decentralized perpetuals exchange who's been offloading Bitcoin in huge chunks. We're talking 20,000 to 30,000 BTC at a time. Yeah. And what really concerns traders here is the sheer size, combined with the complete unknown of how much more they could sell. How deep does that bag go? The psychological impact of these huge moves by whales, you really can't overstate it. When an unknown entity with that much firepower starts selling, it creates immense uncertainty. So traders, fearing a bigger dump is coming, they often sell preemptively, which, just makes the price declines worse and adds to that overall feeling of vulnerability. It's a classic example of how one big player can really influence short-term prices and sentiment regardless of the fundamentals. It definitely feeds into that breaking down narrative for a lot of people.
And if that wasn't enough drama to keep everyone on their toes, we've got this big macro watch this week that could easily overshadow everything else. We're looking at GDP numbers coming out Thursday. Okay, but the really crucial one, the one everyone's laser focused on, is the Personal Consumption Expenditures Index, PCE. Friday. This isn't just another economic report, right? This feels like a major data point for our market.
Indeed, yeah. PCE is incredibly important because it's the Federal Reserve's preferred inflation gauge, their favorite one. Unlike some other metrics, it tracks what people are actually spending money on, and it adjusts for changes in buying habits. So it's seen as a very accurate measure of inflation. Now, here's the direct impact for us. If Friday's PCE number comes in hot, meaning inflation is still running too high, the Fed will have, well, less reason to cut rates in September. And if Fed Chair Powell hesitates on those rate cuts, that won't be good news for risk assets.
Right.
That includes stocks, crypto, you name it, they won't be happy. It's a stark reminder that even as we talk about decentralization, crypto's fate, at least in these market phases, often hangs on the words and policies of just a few people in centralized institutions. It's almost ironic, isn't it?
It really is.
If you connect this to the bigger picture, you can see just how closely crypto's performance is tied to broader economic policy and these key inflation numbers.
Yeah, it does, doesn't it? And for those who often see crypto as an escape from traditional finance, that kind of long shadow, it can be a tough pill to swallow sometimes. So let's say PCE does come in hot Friday, forcing the Fed's hand. What specific areas or narratives within crypto do you think bear the brunt of that impact first, most immediately?
That's a great question. A hot PCE basically implies higher interest rates sticking around for longer. That directly increases the cost of capital. For crypto, this usually hits the highly speculative stuff first. Altcoins, projects relying heavily on future growth stories rather than, say, immediate utility or revenue. Think of it like tightening the screws on innovation capital. Narratives around yield, maybe even some DeFi protocols, might also feel pressure as safer traditional finance yields start looking comparatively more attractive. That breaking down scenario would likely accelerate for projects that lack strong fundamentals.
That brings us perfectly to the current mood on the street among traders. And it sounds exactly like what you expect after a week of whale drama and scary macro data looming. It's shaky right now. People are definitely on edge. Bitcoin keeps sort of drifting lower, and you're hearing more and more chatter about drops towards under $1,000, maybe $102,000, even lower. And frankly, ETH stalling out under $5,000 certainly didn't help confidence either, which means, yeah, altcoins are mostly looking pretty weak across the board.
And this just underscores the huge impact of social sentiment in crypto markets. It's different from traditional markets sometimes. Unlike TradFi, where institutional analysis often dominates, crypto communities really thrive on narrative and collective mood. When confidence wavers like this, that shared anxiety can quickly amplify selling pressure. It can turn a mild correction into a much more significant dip as traders react to what they perceive as weakness, and all the talk about lower price targets. It's often a self-reinforcing loop that can move faster than the underlying fundamentals in the short term, pushes us further into that breaking down narrative.
But okay, amidst all that weakness, there's this one altcoin that's really standing out, almost defying gravity, it feels like. Hyperliquid, HYPE. It's basically the only major alt holding its ground right now, which is pretty remarkable given the overall market mood.
And there's a clear, quantifiable reason why HYPE is holding strong while others are faltering. It's not just random. Its rising platform revenue is consistently fueling significant token buybacks by the foundation. In just the past 30 days, they've scooped up over $100 million worth of HYPE tokens from the open market.
Wow, $100 million.
Yeah. That creates strong, sustained demand-side pressure. It helps stabilize its price, even when the broader altcoin market is really struggling. It's a tangible value proposition that resonates with investors looking for some resilience.
Absolutely. And it's not just the buybacks, is it? It's also apparently easily the most socially loved project of this cycle, which, as we know, is a huge factor in crypto, often underestimated. That kind of community love and momentum can be a powerful force. Reminds me a lot of how Avalanche and Solana captured that same kind of fervent community support back in the last cycle, really propelled them forward. But outside of HYPE, though, yeah, almost every other alt is having a pretty tough time. Clearly shows the prevailing cooling off for the rest of the market. It's easy to get caught in the daily volatility, isn't it? The price swings, the headlines screaming caution. But beneath all that immediate drama, there's another story playing out these significant strategic moves being made by major players in the background. Let's shift focus for a minute to these under-the-radar developments because they often paint a very different picture, maybe one of long-term conviction, signaling that while some things are cooling off, the foundational building is very much continuing. Okay, first up, Bitwise. They've filed with the SEC for a spot Chainlink ETF. This isn't just another product filing.
It feels like a testament to Chainlink's evolving role, moving from maybe a niche crypto asset to recognized financial infrastructure, What does this mean for its integration into the wider market?
This is indeed significant, yeah. For investors, it offers regulated exposure to illing, sure, bypasses needing to hold or stake tokens directly. But more profoundly, it signals institutional recognition of Chainlink's critical Oracle services. I mean, those services are essential for bridging TradFi with decentralized DApps. This kind of move attracts a different class of capital, typically more conservative, long-term focus. And that speaks volumes about conviction in the underlying tech, even when daily prices are shaky. It suggests a belief in Chainlink's foundational role, sort of regardless of short-term market sentiment swings.
Okay, moving from market access to deeper capital flows, we're seeing some truly significant investment plays. Pantera Capital, for instance, is making a really ambitious move for Solana. They're planning to raise, an eye-watering $1.25 billion for a Solana-focused treasury company.
That's right.
If they pull this off, it could be the largest fund of its kind. That's a serious, serious commitment to the Solana ecosystem, isn't it? What does that signal about how smart money views Solana's future?
It signals that despite any short-term FUD or technical hiccups Solana might have had, Pantera sees immense long-term value there, a fund of this size. It's not about day trading. It's about investing in the core infrastructure, the developers, the projects that they believe will define the next wave of adoption on Solana. It's a very strong vote of confidence. Signals that major institutional players believe Solana has the scalability and, importantly, the developer mindshare to be a dominant layer one for years to come. This kind of capital infusion isn't really a cooling off signal at all. It's a foundational investment aimed at future growth.
Then you've got ETH, which is an Ethereum treasury firm. They recently announced a $250 million stock buyback. Okay, but here's the interesting part for us. They're also significantly growing their ETH stash, now holding more than 102,000 tokens. So they're signaling confidence both in their own company and in Ethereum itself, kind of simultaneously. A dual vote of confidence.
Absolutely. A stock buyback signals confidence in their own valuation and future, sure, but accumulating more Ethereum at the same time, that's a clear statement of belief in ETH as a core asset for the future of DeFi. They're effectively doubling down on the asset that underpins their whole business. They seem to see the current market conditions as an accumulation opportunity rather than a sign of some fundamental breakdown. This strategy suggests a long-term bullish outlook from people who are intimately involved with the Ethereum ecosystem.
And on the interoperability front, making everything work together, dBridge has expanded its cross-chain protocol to include Tron. This is significant because it means integrating the USDT-heavy network of Tron with Ethereum, Solana, and over 25 other blockchains now. It's all about making those connections smoother, more efficient across the whole crypto landscape. Why is that specific integration with Tron particularly noteworthy?
Well, this raises an important question for us, doesn't it? When you look at these headlines together, a Chainlink ETF, that massive Solana fund, a firm stacking ETH, significant cross-chain integrations like Tron, which is primarily a stablecoin hub, they all reflect ongoing institutional interest in fundamental infrastructure building. That's the common thread. Even amidst the short-term market uncertainty and the daily price swings we're seeing, these are pretty undeniable signs of long-term conviction in the space. It suggests that while traders might be spooked by whale moves or macro data points, significant players are still building, investing, expanding, signaling a belief in crypto's enduring future. The Tron integration specifically is significant because it connects a huge pool of stablecoin liquidity, mostly USDT, to the broader DeFi ecosystem, enhances capital efficiency and utility. It's a really pragmatic step towards a more interconnected, robust, decentralized world.
That's a great distillation. Yeah, it's easy to get caught up in the minute by minute, but these developments really remind us there's a bigger picture playing out. And speaking of big pictures, let's dive into what some of the top experts are saying about where we might be headed. So Cowan presents this compelling case for caution, short term, but it seems to hinge pretty heavily on historical patterns, right? What if this cycle truly is different? How do we weigh those historical precedents against, say, the Bankless team's more optimistic extended cycle thesis, especially with their points on global liquidity? But first, let's unpack Benjamin Cowan's perspective on Bitcoin's path, specifically his bull market support band. What is that exactly?
Right, Benjamin Cowan. As many of you know, he's a respected voice in crypto analysis known for his data-driven approach. He's been focusing on Bitcoin's price action through the lens of the bull market support band. Now, This band, for those who follow technical analysis, it combines the 20-week simple moving average and the 21-week exponential moving average. It's not just about the averages themselves, but how their convergence creates this dynamic support zone. Historically, it's acted as a pretty reliable proxy for Bitcoin's underlying momentum during a bull run. And breaching it is often seen as a critical signal for a potential shift in the trend. Currently, this band sits around $107,000. Cowan believes that any recent rallies we've seen are likely temporary and will probably be sold off. He expects Bitcoin to revisit this support band around $107,000 sometime in September based on historical patterns observed in previous post-halving years.
Okay, so Cowan's framework really zeroes in on those critical support levels. But beyond just hitting the band, what are the implications if Bitcoin tests that $107,000 mark and holds? Does that instantly mean the bull market's back on? Or are there other factors we should watch for a true reset versus a breakdown? He outlines two key scenarios, right? If the bulls manage to defend that $107,000 band, okay, it could signal a market reset, might pave the way for another move up later in the year, maybe October timeframe. But if Bitcoin falls below that band, then the next line of defense is the 50-week moving average, which he puts around $95,000. And historically, if Bitcoin gets 2 weekly closes below that $95,000 level, that often signals the end of a cycle and could lead to much bigger drops, shifting us firmly into that breaking down scenario.
Exactly. What's fascinating here is how this technical analysis provides a clear framework for you, the listener, to understand potential downside risks and identify key support levels to watch. Cowan's perspective encourages a cautious approach right now, suggests a significant test of support is probably imminent. This framework helps you interpret market movements not just as random ups and downs, but as data points relative to historically significant indicators. It gives you a structured way to watch for shifts in the trend. It provides a crucial sort of roadmap for trying to figure out if we're merely cooling off or if a more fundamental breakdown is actually underway.
That gives us a good sense of Bitcoin's immediate future, potentially. But what about the longer game? The overall cycle. The team at Bankless recently had this really interesting discussion with Ryan and Michael from the DeFi report asking a huge pivotal question. Will crypto peak in 2025 or run into 2026?
This debate really encapsulates the current market tension, doesn't it? That short-term caution versus the longer-term potential. It absolutely does. The classic 4-year cycle pattern in crypto is pretty well established, as you know. Bitcoin topped in December 2013, then again December 2017, and then late 2021. Following this historical pattern, the next peak would logically fall somewhere around Q4 2025. This historical data provides a strong argument for why many people anticipate a similar peak next year, leaning into the idea that this cooling off we're seeing now is just a precursor to that classic cycle peak.
Right. But Ryan and Michael from Bankless, they also lay out some compelling arguments for why this cycle could extend into 2026. Challenging that traditional view, they point to a few key factors. First, global liquidity is apparently still expanding, which generally supports risk assets like Bitcoin and Ethereum. Second, banks are starting to loosen their lending standards. Even though loan demand is low right now, this suggests there's potentially a lot of dry powder, capital just waiting on the sidelines, that could enter markets later on. And third, if the labor market weakens significantly, the Fed might be compelled to cut rates, which historically pushes investors out of cash and into assets, like crypto. They also noted that while on-chain data shows long-term holders are selling, it's apparently not at extreme levels yet, meaning we haven't reached that final euphoria phase that often precedes a major market top. This suggests the market isn't maybe overheated enough for a classic 2025 top, perhaps arguing for a longer, more extended run.
Exactly. So for you watching this, the signals to watch become critical. If Bitcoin undergoes a correction, maybe down to those Cowan levels, but manages to hold above key support, that could signal a healthy market reset, which might then allow for an extended run into 2026, defying that traditional 4-year cycle timing. This would be like a prolonged cooling off that eventually leads to a more robust, maybe longer bull market. Conversely, if Ethereum breaks higher really quickly, maybe surges past $5,000 soon, that might indicate a more traditional accelerated run towards a Q4 2025 peak, signifying a more rapid cycle conclusion. If we connect this to the bigger picture, what you're seeing is this fundamental tension between established historical patterns and the new macro realities that could shape this cycle in, well, unprecedented ways. It's a dynamic interplay, requires careful observation of both technical indicators and these broader economic shifts to determine if we're just pausing or if the very structure of the cycle might be shifting.
Wow. What a ride today has been, exploring the incredible complexity of this market. We've covered so much ground. From the current market vulnerability of Bitcoin and Ethereum, those critical macro influences like the PCE report coming Friday, to the surprising social buzz and resilience around HYPE. We also looked at the continuous institutional developments happening behind the scenes, which is encouraging. And then, of course, these differing expert views on Bitcoin's immediate path from Benjamin Cowan and that big question about the overall cycle duration from Bankless. It's a lot to process.
Absolutely. I think what we've seen today is that the market is truly at a fascinating crossroads, a real inflection point, perhaps. We have this mix of clear short-term caution, the potential cooling off period for ETH, Bitcoin struggling at key levels, the whale activity, macro uncertainty, all that. Yet simultaneously, there are these powerful underlying signals that could extend this bull run, from expanding global liquidity and ongoing institutional building to a market that, according to some data, hasn't yet hit peak euphoria. It really reinforces the idea that it's crucial to look beyond the daily noise, the daily fluctuations, to understand these deeper, sometimes conflicting underlying drivers. They'll ultimately determine if we're just catching our breath or if we're truly breaking down.
So what does this all mean for you, the listener, as you try to navigate this complex crypto landscape? How do you possibly make sense of it all?
Well, given this rich mix of cautious market sentiment right now and that steady drumbeat of long-term institutional building, how might you interpret the next major economic data release, like Friday's PCE number? How do you view it in light of these conflicting cycle predictions? Are we witnessing just a pause before a potentially extended run into 2026? Or are we seeing signs of a more fundamental shift in market dynamics that points towards a more traditional, maybe sooner 2025 peak? Consider which signals you find most compelling right now and how you might adjust your perspective based on what unfolds next in this really fascinating, constantly evolving market.